jump in. So thank you to everyone for joining today on your lunch break, taking time with us to talk about interest rates will be the main focus, and discount rates as it relates to your lump sum, as well as some stock strategies and options is what we'll be kind of covering today. So let's get going. All right. So my name is Morgan. As I said, I do work here at Bogart Wealth. I'll share a little bit about Bogart. Just so you know, this QR code is if we don't already work with you, or if you have a question, if you actually scan this QR code, it will take you to our website, to the exact area where you can enter your information, and we'll reach out to you and give you a call. I have been at Bogart Wealth for 4 years. I've actually been in the industry for 20 years. I am a certified financial planner and one of the financial advisors here. I live locally in the Northern Virginia area with my husband and 3 kids as well. So a bit about Bogart. We actually just celebrated our 10-year anniversary. So we were founded in 2016. We have about 1,400 families that we support. As I mentioned, I am in our McLean office here just outside of DC, but we also have 2 offices in Texas as well. We have $3.3 billion that we are tasked with helping our clients to watch over and make smart decisions with. And we've been growing a ton, especially if any of y'all have been with us for a while or following us. We now have over 50 employees, which is substantially more than even when I started 4 years ago. So let's talk about discount rates and how they affect the lump sum. So one thing to note when we're talking today about interest rates, generally I'm going to be talking about the ExxonMobil pension program. If you are joining or listening to this recording later and you also have a pension offering that has a lump sum, some of this may be relevant to you. I don't know specifically, so just kind of noting that this is geared toward, as we know, the details of the ExxonMobil plan. But we're going to talk today about how it impacts the pension lump sum, and then also just what's going on with interest rates in general. And again, we'll be talking about the qualified portion. Just another thing to note, if you are joining and work at ExxonMobil, the interest rates don't impact what we're discussing, isn't relevant if you have a non-qualified pension, like APP or SPP. We're just going to be really talking about the qualified pension plan. I will start too at a very basic level, like what is the discount rate? So the discount rate is the assumed rate of return that they're assuming if instead of taking your monthly amount, you say, okay, I just want a lump sum amount, then they have to assume, well, what is the rate of return? How much do we need to give you? What is the rate of return you're going to get on that to recreate those payments? So if you say, for example, instead of getting $5,000 per month for the rest of my life, the discount rate is saying, okay, well, how much do you need? What is that lump sum equivalent? Assuming you earn X rate, and we'll talk about those, for you to pay yourself $5,000 per month for the rest of your life. So which discount rate applies to me? For the vast majority of everyone on this call, and most clients that I work with, we'll be talking about the general rule. There are some that are grandfathered and they have a choice. They have a little bit of flexibility with their rate that they're going to use, and we'll kind of define what does it mean to be in the grandfathered rate. But just know it's very likely, if you're listening in, that the general rule is what will be applying to you. So your benefit commencement date, it's a mouthful, so I might abbreviate to BCD throughout the call. But that is just what is the first day of the month following your retirement date. So today is July 15th. If you're retiring today, congrats. That also means your BCD would be 8/1. So even if it's on a holiday, doesn't matter. It's just the first of the month following your retirement date. And so the discount rate that applies, it actually goes back 2 quarters. So right now, anyone who's retiring in Q3, then you're looking back to the Q1 rates. So the Pension Protection Act, As I mentioned, I actually started working in the industry 20 years ago. So this came out in 2006. We've got that in common. It is a really sweeping, big piece of legislation that came through. I think it was close to like 400 pages, but there was a lot in there. The part that we're going to really talk about today, and the most relevant piece of the act that impacts y'all in the lump sum amount, is that it defined what discount rates can be used. What is that benchmark that we're using? It went from treasuries to corporates, but really made that definition. It also defined actuarial tables that are being used. These have to be updated every 10 years. They can be done sooner, but have to be done every 10 years. Limits companies offering a lump sum. So it's some regulation in place to say, hey, if you're underfunded, then let's say you're 80% funded, then you can't offer a 100% lump sum. This has never happened at ExxonMobil, so that's why we don't really talk about it, but it's just part of, again, some of the bullet points of the things that came out of this big piece of legislation. After-tax balance is going to a Roth. This is something that can impact some on this call as you've got after-tax money in your Voya plan. That's a benefit and something to look at, as well as the others here. So we talked about kind of what was grandfathered earlier versus the general rule. So really all those who are subject, who are following this general rule, are those who were under 50 before 2007. So I think anyone who would have the grandfathered in, I think you're like 69 this year, 68. So again, most people have retired by that age, not always, but that's why the kind of the general rule, the new pension plan rules do apply. So this lovely chart tracks the different segment rates. So when we're looking at the discount rates and for the ExxonMobil pension, there are actually 3 different segments. Now they all come up with a blended rate, but this just shows you, if we're kind of looking back historically, what the 3 different segments have done. So segment 1, which is actually in the green, I think it's not on the little key there, but it's the green one. The one you see that's a little bit more volatile, and that's because this is following short-term rates. So anything like 6 months to 5 years, versus segment 2 is more medium-term, and segment 3 is long-term rates. So all looking at corporate rates, just different maturities. And you'll see that with the segment 1, it is much more sensitive to Fed changes that are made. And so, for example, if we go back to 2020, you see a pretty steep drop there in that year. And that's because we had a global pandemic, and the Fed cut rates really, really quickly. So these respond pretty quickly to that. You'll see in general, they're all moving in the same direction. And again, it's a combination of these rates, but these are the 3 segments that are used. So let's kind of dive in further to it. So keep in mind that the first month, so let's look at segments for third quarter. So if I'm retiring right now, so whether it's anytime in the third quarter, August 1st, if I'm going, the rates that are used to determine my lump sum, again, we go back 2 quarters. So we're going back to the first quarter of the year. For any quarter, the first month doesn't impact the rate. It isn't used to calculate it. That's why you'll see January, April, and July are grayed out here. However, we do still report on them because it can give us a sense of the direction that rates are going. So that's why you'll see those on there. And then what you'll notice here under status is that anything, and this is part of that, if you get our monthly emails, that we send out about the rates, anything that shows actual means it has actually been reported. These are published by the IRS. So the Treasury reports on them, and the IRS actually publishes them when they get around to it. So it depends on what's going on. It can take some time, but anywhere you see actual, okay, this has been published. Projected just means we are estimating it. And so how do we estimate it? If you kind of look to the chart to the right, we are huge nerds, and every single day we go and kind of track it and then take that average over the time. So projected just means it hasn't officially been reported. So even though, for example, June has passed, we're into July, they have not officially reported the numbers for June. And usually there is a bit of delay in that. So let's talk about the single rate equivalent. So as I mentioned, there's 3 different rates. Okay, Morgan, what does that mean? What am I really looking at? So they are all used to come up with this single rate equivalent that you'll see here. So this is used to calculate it. And again, so if you're looking for Q2, not official yet, still projected, but all of these kind of roll up to say what's that single rate equivalent that you'll see. So we have seen interest rates over the most recent quarters moving up a little bit. You'll see there hasn't been a huge swing or change, but we have seen an increase in interest rates in that single rate equivalent. Now, I think this is important to look at because as I talk to a lot of people that are approaching retirement and thinking about their lump sum, I get it. You are laser focused on these rates because the higher the interest rate, the lower the lump sum. Remember that the discount rate, the interest rate is used to say, how much can you earn? Let's assume what you can earn on this and get that lump sum. Well, if I assume that you can earn 5% versus 2%, at a 5% rate, I don't have to give you as much money to replicate your annuity payment, right? I'm assuming you can get 5% on it versus if you're only getting 2%, the lump sum's higher. So think back to 2020 when we saw rates drop. Many people were refinancing, very different ways you're kind of taking advantage of those lower rates. It was also very, very helpful for the lump sum and increased the lump sum payments during that time. So although we've seen them go up recently, I bring that up to, look beyond. We've got that recency bias. We're thinking about 2020 like, gosh, those rates were so low. But as we look back to the rates that have been published going back decades, you'll see we're still relatively low, especially as we're thinking back to the 80s and 90s, still some more favorable rates. So just putting some perspective in what we've seen historically with these rates. So let's talk into and dive a little bit further about the impact on the lump sum. So this shows you an example here that where we've got, here's the rates, here's the, let's assume $1 million. The relative difference that you'll see here is that anytime we see the rate go up or down, and we'll talk about this in a later one, if you see the rate go up by like 1%, it's usually like a $10,000 drop. So it's just kind of a rough rule of thumb. But this shows you calculating that lump sum value. Okay, based on if I were to get the annuity of $74,000 per year, again, actuarial tables, assuming that you're living to 84, then here's that present value, right, of 1% using that rate of return. If we were to look at it and say, okay, so this is someone who's going to retire earlier, right? So at age 55, there is a bit of a reduction for anyone. So before age 60, there is a discount factor. So forget the segment rate. This example, the segment rates are exactly the same as the example we just looked at. But you'll notice that the lump sum value is now closer to $800,000 versus $1 million. And that's really due to that discount rate that is taken into account. Now, there are ways to, you can control the discount rate in the sense that even if you retire at 55, you can elect to defer the lump sum payment and to kind of reduce that discount factor. That's something we counsel clients on if that makes sense or not. And there's a variety of factors that go into it. But just know if you do retire early, you can still elect to defer the lump sum. So this is getting very much into the weeds, but this is showing, okay, what if we really calculate how is the single rate or that internal rate of return calculated to go in there? our team does this for you. It's part of the pension calculation. So there's nothing that you need to memorize from this necessarily. I certainly have not memorized this calculation, but they basically run through different scenarios, right? With segment 1, segment 2, and segment 3, and then come up with that total single interest rate or factor. So rate changes on the lump sum. Again, this is the biggest thing I hear with people trying to maybe time the interest rate or think if you're nearing retirement, okay, is it smart to try and go at a different quarter than the other based on the direction of interest rates? As you saw earlier in the kind of historically what the short-term rates are doing, we haven't seen really big changes in interest rates for the past few quarters. So again, if you're thinking lump sum, say $1 million, interest rate change of 1% equals 10% change in lump sum value. So if rates go up by 1% and assuming your lump sum is $1 million, it's a $10,000 change per million. So what we've seen the past quarter or two, it's really been closer to like a 0.1% change. It does impact it, but we haven't seen anything that's really compelling enough to say, hey, push one quarter versus the other. Again, looking at all the other factors. When we did see 2020, there were really, really swift changes. I mean, those are probably the quickest interest rate changes we've seen in decades. So, there we could see a 1%, change, but it's just a great rule of thumb to know and kind of have in the back of your mind, okay, rates have to go up by 1%. And if so, it's about 10,000 per million. So you've kind of got that into context. So this shows the lump sum value as a scenario that we saw earlier, but earlier we're looking at someone retiring at 55 and they had that discount factor. Here, that discount factor doesn't apply. So we're really just looking at the interest rate, factoring into it. And so lump sum value is a bit higher here. So thinking about, do you want to take it now or defer? Again, it really depends on quite a few things. Do you need the money right away? Are you retiring before 60, right? That discount rate. Where do you expect interest rates to go? No one can perfectly predict where interest rates will be. Not even us, right? We can kind of directly say, hey, we think in general they're going up or down, but really actually pegging what the Fed's going to do. We'll see. It seems likely that interest rates are going to stay higher for longer, that we're not probably going to see that significant of a jump. But just something to think about, again, something we can help you with planning and going through a detailed financial plan one-on-one to say, what if you take it now? What if you take it later? We can really run those scenarios to quantify it. Because I know there is always that fear of the interest rate movement impacting it, and it does, but there's so many other things that we want to take into account. So this is a roadmap that we like to give clients. It's kind of detailed, and we're talking about, hey, here's just one factor. What about the lump sum? But there's a lot of other decision points as you are going through retirement or approaching retirement. What to do with your savings plan, NUA or net unrealized appreciation, which is a whole nother podcast and kind of webinar we do in and of itself. But hey, if you have shares of company stock, how do you treat those? And when can you make these choices? So this is something that we help with just to make sure everything's on time. You get the lump sum payment if that's what you elect as soon as possible. And this is just a different way to kind of show you that. So let's talk about covered call strategies. So going to pivot quite a bit from the lump sum. So this is relevant to, well, any stock, but I would say the number one reason we're bringing it up is because we do find that for many of the ExxonMobil retirees, they do have shares of company stock in their 401k and savings plan. And if you elect to take it out, move it over in kind into a brokerage account, a personal retirement account, then the world kind of opens up for different strategies that you have available. And one of them is covered calls. So again, this can apply to any stock out there, but most often we're seeing it and discussing it and utilizing it for clients with company stock that they choose to move out of the plan in kind. And we'll go over what a covered call is. So some of the key terms we'll talk about, the strike price, the time frame, the premium, and the underlying stock. So here's an example. So I own shares of ABC stock at $100 per share, and I'm willing to sell the covered call or give someone the option to buy these shares if it goes to 120. And so the premium is $3 per share. One call is 100 shares. So in this example, let's say I'm going to cover, I have 1,000 shares. So I'm going to sell covered call for 1,000 shares. So I've made $3,000 right off the bat. So I am now saying to whoever's the buyer on the other end, don't know, they have the ability to buy my shares at $120. I get the $3,000 right away. Reinvest it, spend it, whatever, it goes into the account. It really depends on, hey, what's the stock going to do? So we'll talk about the scenarios if it executes, if it hits 120 or goes above $120 per share. It certainly could stay in that range, right? And if it's at $100 now, anywhere between now and 120, what happens if it stays in there at the expiration date? Anytime you write or sell a covered call, there's always an expiration date. You can't just pick any date you want, but there's ranges, right? So it's common to look and see, okay, it's maturing in 9 months or 12 months, but there's kind of an end date. It isn't this open-ended to say, hey, purchaser of my my option, you can buy it for 120 10 years from now. There's usually a shorter time frame for which it's good through, the contract's good through. So in this example, let's say that at the expiration, the stock goes up to $125 per share. If I'm someone, if the stock's currently trading at 125 and I've paid for it, I have the ability to buy it at 120. That seems like a pretty good deal. I could turn around, sell it right away, right? And I've made $5 minus the premium you paid. So if it goes above it before expiration, then the person has the right to go ahead and say, yep, you've got to sell me those shares at 120. In this example, if I'm the person who sold the covered call, well, I sold it at 120, so I still made money, right? It was trading at 100. I sold it at 120. I still got to keep my premium, $3 per share, $3,000 that I've already kept. And then my opportunity cost was $2 per share, right? Or $2,000. So some advantages and disadvantages to think about. So a lot of people really like it because in addition to owning a stock that may have a great dividend, it's another way to generate income off of the stock. I would definitely say you want to be willing to sell it because when you have the covered call, you're agreeing to sell it. There are ways you can kind of buy it back before. So there is some kind of, hey, undo or want to reverse that, but you're probably going to be selling it even bigger premium to buy it back. So not always the best thing to do, but it is an option for you. But you definitely want to be first and foremost willing to sell the stock. It caps the upside. It does give some downside protection in the sense that you've got the premium, right? But the stock could still, go down and you're subject to that. But it's also just a great way to divest of shares. So if you are willing to sell it and there is a price, you feel like, hey, this is a good price to sell at, and then you're also getting that premium on top. It's a great way to kind of diversify out of the shares. So let's talk about some changes that came through recently. So age 50 catch-ups must be Roth for certain individuals turning 50 this year. More flexibility, kind of more catch-up for those that are age 60 to 63. This is new starting in 2026. This was part of the Secure Act changes that we saw come through quite a few years back, but they wanted to give plan administrators time to implement and to set the plan up in a way that it could actually execute on those guidelines in the Secure Act. So a couple of things too that we saw come through as well. So last year we had a pretty big tax law that came through last July 4th, so right at a year ago. And what it did was extend some of those lower tax brackets and more favorable item standard deductions that we had since 2017. So it was kind of coming up to sunset. One thing that has been, I think, really helpful for a lot of people, especially in Northern Virginia or DC area, anywhere where you have higher, tax, is that if you are itemizing, it's no longer capped at 10,000. That actually increased up to 40,000. So pre-2017, you could deduct all of your state and local tax, right? Your real estate tax, and state income tax if you pay that. So it was capped at 10 and it went up a bit. So still capped, but a much more generous cap. There is a phase out there for some high income earners, but it's a pretty high phase out that they put in place. The estate tax exclusion, which is continuing to go up, right, increased to 15 million per person. So for this year, if you're married filing jointly, that is 30 million that you can have in your estate and not be subject to estate tax on that money. And then there were some changes for the charitable giving as well. So they brought in something that we saw also kind of similar during the global pandemic during 2020, where if you are itemizing, there's kind of an additional like above the line deduction that you can take, and then some adjustments if you're itemizing to that as well. So strategies to think about now, if you're considering retiring or for anything, right? Even if you're still 10 years out, always have a plan to start to run the analysis. We would love to run a financial plan for you. It's something that we do complimentary because we think it's important for someone to have that experience and see what would it look like to work with an advisor. So we don't charge for it. We can always run some of those projections for you, whether it's retirement planning, college planning, whatever that might be. Create a budget. So I find this is usually the one thing that holds people up when it does come time to planning. You know, we're gathering the data, statements, things. So that's all very easy to get. Sometimes it's really hard to just say, here's what I'm spending. So starting to track that is something that I think is always great to do. Understanding your cash flow needs, right? So you can kind of think about those future expenses. And then just really knowing what is your long-term risk profile. So how does your investments lined up with that? So what can you do? We're here to help. So give us a call. I'm going to show you the QR code here in a minute. We would love to help you out. You can also just go to bogartwealth.com if you don't have your phone to take the QR code. And there's a way to let us know there if you want us to reach out or have any questions. If you already work with someone, reach out to your advisor. They would love to help if you have any questions on what we discussed today. Thank you for joining.